There's something about Warren Buffett that's always bothered me, and I've never said this publicly before. Warren is a friend. I respect him enormously. He's one of the greatest investors who ever lived. Berkshire Hathaway's track record speaks for itself. 20% annualized returns over 6 decades. Extraordinary. But there's a contradiction, a gap between what Warren tells individual investors to do and what he actually does himself. And after 50 years in this business, after managing over $11 trillion at BlackRock, I think it's time someone said it out loud. Warren's public advice to individual investors is simple. Put 90% of your money in an S&P 500 index fund and 10% in short-term government bonds. Passive, diversified, low cost. Set it and forget it. And you know what? For 95% of people, that's probably the right advice. But here's what bothers me. Warren doesn't follow his own advice. His portfolio at Berkshire Hathaway? Highly concentrated. Maybe 20 stocks at most, sometimes fewer. Active management, private deals, whole company acquisitions, operating businesses. 0 bonds in the equity portfolio. So which Warren Buffett should you listen to? The one giving advice to everyone else? Or the one actually building wealth? Now, before the Buffett disciples flood the comments, let me be clear. I'm not attacking Warren. I'm not saying he's wrong. What I'm saying is there's a gap, a tension between passive advice and active execution. And understanding that gap, understanding why it exists and what it means for you, that's what separates sophisticated investors from everyone else. Today, I'm going to walk you through why Warren gives the advice he gives, even though it's not what he does, when passive investing works brilliantly and when it fails, the math behind concentrated portfolios, the risks and the rewards, how everyday investors can access some of the strategies Buffett uses, and the hybrid approach I actually recommend for most people. This isn't about worshiping Warren Buffett or dismissing him. This is about thinking clearly, understanding trade-offs, and building a portfolio that works for your specific situation. Let's get into it. First, let's establish the facts. What does Warren Buffett actually tell individual investors to do? In his 2013 letter to Berkshire shareholders, Warren laid out instructions for how his estate should be managed after he's gone. His advice to the trustee? Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. He's repeated this advice countless times in interviews, annual meetings, and public statements. For the great majority of investors, a low-cost index fund is the most sensible equity investment. Simple, clear, passive. And here's the thing, he's not wrong. For most people, this is excellent advice. But now, let's look at what Warren actually does. Berkshire Hathaway's equity portfolio is concentrated in roughly 45 stocks, but the top 10 holdings represent about 85% of the total value. Apple alone is over 40% of the public equity portfolio. That's not diversification, that's concentration. Beyond the public stock portfolio, Berkshire owns entire companies outright. Geico, BNSF Railway, Berkshire Hathaway Energy, Dairy Queen. Dozens of wholly owned businesses, and the bond allocation? In the equity portfolio, it's essentially zero. Berkshire holds cash and short-term treasuries for liquidity and acquisitions, But that's different from a retirement portfolio with 10% bonds for stability. So there's the gap. Passive advice, active execution. 90% diversified index fund? No, 40% in Apple plus concentrated bets. 10% bonds? Not in the operating portfolio. Set it and forget it? No, constant capital allocation decisions, acquisitions, management oversight. Now, why does this gap exist? 3 reasons. First, skill and time. Warren has spent 70 years studying businesses, reading financial statements, understanding competitive advantages. He works 80-hour weeks. He has a team of analysts. He has direct access to management teams. Most individual investors don't have that skill, that time, or that access. And Warren knows this. He's not being dishonest when he recommends passive investing to others. He's being realistic about what most people can actually do successfully. Second, scale. Warren manages billions of dollars. He can buy entire companies. He can negotiate deals that aren't available to ordinary investors. He can influence corporate strategy. An individual investor with $500,000 or even $5 million can't do that. So the strategies available to Warren simply aren't available to most people. Third, psychological discipline. This is the one people overlook. Warren can hold Apple through a 30% drawdown without blinking. He can watch a stock fall for 2 years and not sell. He can ignore market panic and keep buying. Most individual investors can't. They panic. They sell at the bottom. They abandon their strategy at exactly the wrong time. Warren knows this. He's seen it for 70 years. And he knows that passive investing removes the psychological decision-making that destroys most active investors. So here's what I want you to understand. The gap between Warren's advice and his actions isn't hypocrisy. It's realism. He's telling you what will work for you given your constraints. But he's doing what works for him given his unique advantages. The question is, where do you fit on that spectrum? Are you Warren Buffett? Do you have his skill, his time, his resources, his discipline? If yes, maybe you can run a concentrated portfolio. If no, and for 95% of people the answer is no, then passive investing is the right choice. But here's where it gets interesting. There's a middle ground, a hybrid approach that captures some of the benefits of both worlds without requiring you to be Warren Buffett. And that's what I'm going to show you. Let me be very clear about something. I am a massive believer in passive, low-cost index investing for the core of most portfolios. At BlackRock, we pioneered iShares, the largest ETF platform in the world. We manage trillions of dollars in index funds. We've spent decades advocating for passive investing. Why? Because the data is overwhelming. Over 10-year periods, about 85% of active fund managers underperform their benchmark after fees. Over 20 years, it's over 90%. That means if you pick an active manager at random, you have a 9 in 10 chance of underperforming a simple index fund over 2 decades. Those are terrible odds. And this isn't a new phenomenon. It's been true for decades. Study after study confirms it. So, for the core of your portfolio, the 60%, 70%, 80% that you're relying on for long-term wealth building, passive index funds are the right choice for almost everyone. But, and this is a big but, passive investing isn't perfect. It has limitations. Limitation 1. You own everything, including garbage. When you buy the S&P 500, you're buying all 500 companies, the great ones, the mediocre ones, and the terrible ones. You're buying companies with no profits, no competitive advantage, no future. You're buying companies that will go bankrupt. You're buying at any valuation, regardless of price. Warren Buffett doesn't do that. He's selective. He only buys businesses he understands, with strong competitive advantages, run by people he trusts, at reasonable prices. And that selectivity matters. Limitation 2. Market cap weighting creates concentration risk. The S&P 500 is weighted by market capitalization. That means the biggest companies have the biggest weight in the index. Right now, the top 7 companies, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla, represent about 30% of the entire S&P 500. So even though you own 500 companies, your returns are massively dependent on 7 stocks. If those 7 stumble, the entire index stumbles. That's concentration risk disguised as diversification. Limitation 3. No downside protection. Index funds are fully invested all the time. If the market falls 40%, your index fund falls 40%. There's no risk management, no moving to cash during bubbles, no selling overvalued sectors. You ride the wave up and you ride the wave down. Warren Buffett doesn't operate that way. When he can't find attractive investments, he holds cash. In early 2024, Berkshire was holding over $325 billion in cash and equivalents. That's optionality. That's dry powder for when opportunities appear. Index funds don't have that flexibility. Now, despite these limitations, I still believe passive investing is the right core strategy for most people. Why? Because the alternatives are worse. Trying to pick individual stocks, most people fail. Hiring an active manager, 90% underperform. Timing the market, nearly impossible to do consistently. So passive wins by default. It's not perfect, but it's better than the realistic alternatives. But here's what I want you to consider. What if you didn't have to choose between 100% passive and 100% active? What if you could build a portfolio that's mostly passive, capturing the benefits of low costs, broad diversification, and disciplined execution, but with a small allocation to more active, concentrated strategies? What if you could be 80% index investor and 20% Buffett-style investor? That's the hybrid approach. And it's what I actually recommend for people who have some investing knowledge, some time to dedicate, and the discipline to stick with it. Let me show you what that looks like. Warren Buffett runs a concentrated portfolio. At any given time, Berkshire might have 80 to 90% of its public equity value in the top 10 holdings. And there's a mathematical reason for this. Concentration is how you generate outsized returns. If you own 500 stocks, your returns will be average by definition. You can't beat the market if you are the market. But if you own 10 stocks, and you're right about those 10, you can beat the market significantly. The question is, what are the risks and what are the rewards? Let me walk you through the math. Scenario 1. Diversified index fund, 500 stocks. Expected return, 10% annually over long periods, historical S&P 500 average. Risk, market risk. If the market falls 40%, you fall 40%. But also, if the market rises 20%, you rise 20%. You get exactly what the market gives you. Probability of success, very high over 20+ years. The market has always gone up over long periods. Scenario 2. Concentrated portfolio, 10 stocks. Expected return, if you're skilled, 12 to 15% annually. If you're not skilled, 5 to 8% or worse. Risk, company-specific risk. If one of your 10 stocks goes to zero, that's 10% of your portfolio gone. If you own 500 stocks and one goes to zero, that's 0.2% of your portfolio. Upside. If you pick the next Apple or Amazon early, your returns could be 20%, 30%, even 50% annually for a period. Downside. If you pick poorly, you could lag the market by 5% annually, compounding to massive underperformance over decades. Probability of success. Low for most investors. High for skilled, disciplined investors like Buffett. Let me give you a concrete example. Let's say you have $500,000 to invest. You're 45 years old. You want to retire at 65. That's a 20-year time horizon. Path A. 100% S&P 500 index fund. Assumed return, 10% annually. End value after 20 years, $3.36 million. Safe, predictable, boring. Path B. Concentrated portfolio of 10 stocks. You're skilled. Assumed return, 13% annually, 3% outperformance. End value after 20 years, $5.77 million. That's $2.4 million more than the index. Life-changing difference. Path C. Concentrated portfolio of 10 stocks. You're not skilled. Assumed return, 7% annually, 3% underperformance. End value after 20 years, $1.93 million. That's $1.4 million less than the index. You worked for 20 years and ended up worse than if you'd done nothing. So the concentrated portfolio is a double-edged sword. If you're right, the rewards are enormous. If you're wrong, the costs are devastating. And here's the uncomfortable truth. Most people aren't Warren Buffett. They're not skilled enough, disciplined enough, or patient enough to run a concentrated portfolio successfully. I see this constantly at BlackRock. Individuals come to us after trying to pick stocks for 10 years, and they've underperformed a simple index fund. They thought they were smart. They thought they could beat the market, and they were wrong. But, and this is important, some people can do it. Not many, but some. If you have deep knowledge of specific industries, time to read financial statements and research companies, emotional discipline to hold through volatility, patience to wait for the right opportunities, humility to admit mistakes and cut losses, then maybe you can allocate a portion of your portfolio to concentrated bets. Notice I said a portion, not all of it, a portion. And that's the hybrid approach I'm going to show you. Here's another way Warren Buffett invests that most people can't replicate. He buys whole companies. Geico, BNSF Railway, Berkshire Hathaway Energy, Precision Cast Parts, dozens of wholly owned businesses. These aren't public stocks you can buy on an exchange. These are private transactions, negotiated deals, entire acquisitions. And this is where Buffett generates some of his best returns, not from public stocks, but from private operating businesses. Why do private markets offer better returns? 3 reasons. First, less competition. Public markets are hyper-efficient. Thousands of analysts, algorithms, institutional investors, all analyzing the same information, all competing for the same returns. Private markets are less efficient. Fewer buyers, less information, more opportunity for skilled investors to find mispriced assets. Second, illiquidity premium. When you buy a private company, you can't sell it tomorrow. You're locked in for years, sometimes decades. That illiquidity is a cost. And in markets, costs get compensated. You earn a premium for accepting illiquidity. Studies show private equity and private credit return 2 to 4% more annually than comparable public investments. That's the illiquidity premium. Third, control. When Buffett buys a company, he can influence strategy. He can install management. He can allocate capital efficiently. When you buy a public stock, you're a passive minority shareholder. You have no control. Control creates value. Now, here's the problem. Most individual investors can't access private markets. You can't call up a private company and offer to buy it. You don't have the capital, the expertise, or the network. Private equity funds require $5 million minimums and accredited investor status. Private credit deals require institutional relationships. So for decades, private markets were the exclusive domain of the wealthy and institutions. But that's changing. At BlackRock, we're democratizing access to private markets. We acquired Global Infrastructure Partners for $12.5 billion. We acquired HPS, a private credit manager, for $12 billion. Why? Because we see a future where everyday investors can access the same private market opportunities that institutions and billionaires have been profiting from for decades. How? Through new structures. Interval funds. These are mutual funds that invest in private assets but allow quarterly redemptions. You get exposure to private markets with some liquidity. Business development companies, BDCs. Publicly traded funds that invest in private middle-market companies. You can buy shares on an exchange. Private REITs. Real estate investment trusts that own private properties, offering access to non-public real estate deals. Target date funds with private allocations. Retirement funds that include 10 to 20% in private infrastructure, private credit, private equity. These aren't perfect. They're not the same as Buffett buying a whole company, but they give you exposure to the private market premium that was previously inaccessible. At BlackRock, we're seeing pension funds allocate 20 to 30% to private markets, and they outperform 401k plans by about 0.5% annually. 0.5% doesn't sound like much, but over 30 years, it's the difference between a comfortable retirement and a struggling retirement. So here's my point. One of the reasons Buffett's portfolio looks different from his advice is because he has access to private markets that most people don't. But that gap is closing. Not completely, but meaningfully. And if you're building a portfolio for the next 20 to 30 years, you should be thinking about private market exposure as part of your allocation. Not 50%, not even 30%. But 10 to 20%? Absolutely. And I'll show you exactly how to do that in the hybrid framework. All right, let me bring this all together into a practical framework. A hybrid approach that captures the benefits of passive investing while incorporating some Buffett-style concentration and private market access. This is what I recommend for investors who have at least $100,000 to invest, are willing to spend some time on their portfolio, 2 to 4 hours per month, have basic financial literacy, can handle volatility without panicking. If that's you, here's the framework. Core allocation, 60 to 70% passive index funds. This is your foundation. Broad, diversified, low-cost index funds. 40% U.S. total stock market, VTI, ITOT. 20% international developed markets, VEA, IXUS. 10% emerging markets, VWO, IEMG. This gives you global equity exposure, thousands of companies, market returns, minimal costs. No drama, no decisions, just long-term compounding. Satellite allocation number 1. 10 to 15% concentrated convictions. This is your Buffett allocation. 5 to 10 individual stocks that you deeply understand and believe in. Rules. Only invest in industries you actually know. Read the annual reports before buying. Hold for at least 3 years unless thesis breaks. Position size, 2 to 3% each, never more than 5% in one stock. Maximum 10 stocks total. This is where you can outperform if you're skilled, but it's small enough that if you're wrong, it doesn't destroy your portfolio. If your 10 stocks return 15% and the index returns 10%, you add 0.75% to your total portfolio return annually. Over 20 years, that compounds to meaningful wealth. If your 10 stocks return 5% and the index returns 10%, you subtract 0.75% annually. Painful, but not catastrophic because it's only 15% of your portfolio. Satellite allocation number 2. 10 to 15% private markets. This is your illiquidity premium allocation. Access to private infrastructure, private credit, private equity. Options. Interval funds. Blackstone BCRED, Ares ARDC, BDCs. Ares Capital, ARCC, Owl Rock, ORCC, Private REITs, Blackstone, BREIT, Starwood, SREIT, Infrastructure Funds, Brookfield Infrastructure, Global Infrastructure Partners. This allocation should generate 8 to 12% annually over long periods, with low correlation to public stocks. It's less liquid, so only allocate money you won't need for 3 to 5 years. Stability allocation, 10 to 15%, bonds and alternatives. This is your ballast, stability when stocks are volatile. 5 to 7%, short-term bonds, BIL, SHV. 3 to 5%, TIPS, TIP, SCHP. 2 to 3%, gold or commodities, GLD, DBC. This isn't for returns, it's for risk management and dry powder during crashes. Total portfolio, 60 to 70% passive index funds, foundation. 10 to 15% concentrated stocks, outperformance potential. 10 to 15%, private markets, illiquidity premium. 10 to 15%, bonds or alternatives, stability. This is a 100% allocation that's mostly passive, reduces costs and mistakes, partially active, captures upside if you're skilled, diversified across public and private, access to all opportunities, balanced for risk, not all or nothing. Rebalancing, quarterly review. If any allocation drifts more than 5% from target, rebalance. Don't rebalance more often. Let winners run. Just prevent dangerous concentrations. Tax optimization. Hold passive index funds in taxable accounts, tax efficient. Hold concentrated stocks in taxable accounts, long-term capital gains treatment. Hold private markets in IRAs, tax-deferred growth. Hold bonds in IRAs, ordinary income tax deferred. This is the hybrid approach. It's not 100% Buffett, it's not 100% passive. It's 70% Buffett's advice, passive index core, and 30% Buffett's actions, concentrated bets and private markets. Best of both worlds. Let me tell you what I actually do with my own money. Not BlackRock's money, my personal portfolio. Because I think transparency matters. If I'm going to criticize the gap between Buffett's advice and his actions, I should be honest about my own. My allocation. About 50% is in low-cost index funds, global equities, U.S., international, emerging markets. This is my core, my foundation, the part I never touch. About 20% is in concentrated positions, maybe 8 to 10 stocks that I've followed for years, companies I understand deeply, positions I've held through volatility. About 20% is in private markets, infrastructure, private credit, some direct private equity deals that I can access through my network. About 10% is in alternatives and cash, some gold, some tips, some short-term bonds for liquidity. So I practice what I preach, mostly passive, partially active. And my returns? Over the last 20 years, I've outperformed the S&P 500 by about 1.5% annually. Not because I'm a genius, but because I've been disciplined. I've stuck with the strategy. I've avoided major mistakes. And 1.5% annually over 20 years is the difference between $1 million and $1.75 million. Meaningful. But here's what I want you to understand. I have advantages you might not have. I have access to private deals because of my position. I have time to research companies because it's part of my job. I have discipline because I've been doing this for 50 years. If you don't have those advantages, lean more toward passive. Maybe 80% passive, 10% concentrated, 10% private. There's no shame in that. In fact, it's smart. The worst thing you can do is try to be Warren Buffett when you don't have his skills, his time, or his discipline. Be honest with yourself. Know your limitations. Build a portfolio that fits your reality, not your fantasy. And if that means 90% index funds and 10% bonds, great. That's a perfectly good portfolio. But if you have some skill, some time, and some discipline, the hybrid approach gives you a way to capture some of Buffett's upside without taking on catastrophic risk. Look, Warren Buffett is one of the greatest investors of all time. I have enormous respect for him. But he's not a god. He's a human being who built a system that works for him. Your job isn't to copy Warren. Your job is to build a system that works for you. And if that system looks different from his, that's okay. That's actually smart. Because at the end of the day, the best portfolio isn't the one that generates the highest returns. It's the one you can stick with for decades without panicking, without abandoning, without destroying. Discipline beats brilliance. Consistency beats intensity. Every single time. Build your system, stick with it, and let compounding do its work. That's how you build wealth. Not by being Warren Buffett, by being the best version of yourself.